Okay, now it's recording.
Excellent.
It says up here, see it on the left side?
Oh, I sure do. Thank you for
Okay,
that. So I think
all
we'll
righty.
go ahead and get started. Neil, if you want, go ahead and kick us off.
Yeah, welcome everybody to the first part of the two-series webinar dealing with buying a business. Let me introduce myself. My name is Neil Shnider. You'll see me a little bit later. And Alan, you want to introduce yourself?
Sure, absolutely. Thank you so much. Pleasure to be here with you all. My name is Amy Fernandez. I'm with the South Florida District Office, a business opportunity specialist. I've been with the SBA for a little bit over 4 years, worn a lot of different hats. Did some additional government working for a United States Senator as well as in the private sector. Um, Born and raised in Miami, and just a pleasure to be here with you guys all and to work with Neil on this webinar. Just a couple of housekeeping. We are going to ask everyone to go ahead and stay off camera. That way the bandwidth doesn't pull. We do have a chat box. And so if you can put any questions that you have in the chat box, that would be great. We are going to ask that you also remain muted if you're not speaking. Otherwise, you end up hearing a lag, kind of like I'm hearing now. And then Neil will speak from time to time to address me if there's any questions on the chat, and we can address it. So I'll go ahead and put a welcome message on the chat, so you know where it is, and you guys can put questions if you have. Thank you.
Okay, so this is Alan's bio. I think she already said it, but she's she's an outstanding consultant with the SBA, and we work a lot together, the SBA and the SBDC, which is an arm of the SBA, by the way. The Small Business Development Center is an arm of the SBA, and we help clients start, run, and grow their business. We're a no-cost operation, so we are of no cost to the small businesses, and we have consulting centers all over the country. They're in Miami, they're in Fort Lauderdale, they're in Orlando. We're down here in Southwest Fort Myers at the Florida Gulf Coast University. Again, we do consulting as an arm of the Small Business Administration. We're a no-cost, confidential, one-on-one assistance. We have consultants in about 18 different areas of doing business. And when you go to our website, which is up here, SBDC you just register, and we have a triage person that's able to send you to the right consultant based upon your needs. Again, we serve all businesses, startup businesses, growing businesses, and businesses that are operational. So this is who I am. I'll keep adding in new people here, Alan. This is who I am. I'm a CPA, certified public accountant. I'm also a CVA, which stands for Certified Valuation Analyst. And I do a lot of business valuations for either the buy side or the sell side. And they're all informal. You need a valuation if you're thinking about buying or selling a business. For the FGCU SBDC, I do all these kind of consulting stuff. So whenever a consultant comes to our SBDC, they need this kind of help, the triage will send you to me in most cases. This is my bio. I am originally a pharmacist, so I graduated from The Ohio State University in Columbus, Ohio. As a pharmacist, I built a chain of drugstores in Columbus, Ohio. So I was a small business person like you are. For 19 years, I ran drugstores and I built medical buildings in Columbus, Ohio. And I cashed out in 1988, probably before many of you were born. At that time, I went back to The Ohio State University, I got an accounting degree, MBA. I started teaching for 14 years at Capital University and Ashland University, which are liberal arts schools in Columbus, Ohio. and started and became a CPA and started my own CPA practice called the Shnider Group. So I have been where you are now, and now I'm at the level where I am helping you with some of my practical experience that I have and my, of course, academic experience. So this is the disclaimer. I'm not trying to give you any legal or tax advice. It's all I'm trying to do is help you with some solutions and challenges that you might have. And consequently, always you need to be consulting your accounting and legal and tax advisors when you make any kind of business decisions. So what is this all about? This is about how to buy a business. This is a two-part series. This part here is qualitative, I call it. It's qualitative because it doesn't deal with money. It deals with understanding about buying a business. The second part series, which you'll see at the end of the slide, is next week on June 11th. And we will be talking about the financial issues and the quantitative issues of buying a business, how to sell your business, how to buy your business, and how to finance your business. All these things are very important, but I felt they were so important in so much detail that we needed to separate them into two separate areas. So when you're looking at a business to buy, we need to make sure that this is the right type of business that you want to be into. What experience do you have in this business and in the industry in which it operates? It's very nice to say that I want to go into a business, I want to buy this business, it looks good, but do you really have any experience in the business? We never really know what a business is like unless you've been working in it. You know, when I owned my drugstores, I had 7 drugstores, and every one of my managers of every one of my drugstores thought that they understood the business. But they really didn't understand the business. Why? Because they had no idea what I did behind the scenes to make the business successful. The negotiations, the clout, and the networking, and all the stuff it takes to be in business and to be able to make sure that you are successful. So you don't know an industry and you don't know a business, in my opinion, unless you've actually worked in it. How critical is experience in your business? In other words, if you want to go into a restaurant business, how critical is it to understand the restaurant business? What price and payment method is reasonable for you and acceptable to the seller? In other words, you need to look at first the price and can you afford to pay that amount of money? Other issues that we look at when buying a business, we need to keep our emotions out of the decision. That's one of the most important things that I have a problem with people that want to buy a business. They get so excited, they forget about the logic, they forget about the quantitative issues, they forget about, is this business viable? Keep in mind that when we're looking at a business to buy, and we'll get into this a little bit later on, when a seller provides us information, we're looking at history. We're looking at past history. When we look at the tax returns, when we look at the profit and loss statements, when we look at the balance sheets and all that kind of garbage that we get from the seller, the cash flow statements, that's history. We're not buying that business for history. We're buying that business for the next 5 or 10 years. So we need to look at the facts and determine how the outcome of that decision will be in the future. We will use maybe a business broker. A business broker, you have to understand, represents a multitude of types of businesses, but they don't represent all businesses. For example, if I hire a business broker XYZ, they may represent 50, 60, 70 different types of businesses, but another business broker may represent different types of businesses. So when you go with a business broker to find a business to buy, you need to understand that maybe you need to talk to different business brokers so that you can get a variety of choices of types of businesses to buy. They sign up with sellers and they want to sell the business in which they are representing because they make a commission. Just like a real estate broker, they're no different. A real estate broker and a business broker are exactly the same. The only difference is one's selling hard real estate, the other is selling an intangible product. That means a business. And consequently, you need to not place a lot of value into one broker, but look at a multitude of brokers and see what they have. You also might want to look at a franchise. Franchises are quite different animals than a non-franchise, and we'll talk about that a little bit later, because if you buy a franchise, you are locked into certain terms, rules, and regulations. Why? Because the franchisor will tell you what to do, and they'll tell you what you're not allowed to do. They'll tell you whether you can or cannot go into particular territories, because the territories are reserved based upon the franchisee's contract. Will you be an owner of the business that you're going to buy and an operator? Or will you be an owner and just an investor? Will you be a silent owner? And consequently, you need to think about these things. So if you're not going to be an operator and you're going to be an investor, you need to understand what your controls are and how you're going to get your ROI, or return on your investment, because we certainly are investing to get a return on our investment. We want to look at other things. We want to evaluate, is this business that is up for sale, why is it up for sale? Why does the seller want to get out of business? They may tell you why they want to get out of business, but is that the real reason why they want to get out of business? I'm a very inquisitive person. I'm also a very negative person from the standpoint of believing what people tell me. And consequently, just because people say that they want to get out of the business because they want to retire, they want to spend more time with their family, and all the traditional reasons why they want to sell their business may not be the real reason. So what do you have to do? You need to dig in deeper to find out if there are any underlying issues of why they really want to sell their business. The next question is, should you start the business and build it from the ground up? Should you buy a business that's already there, or should you start your own? There's a lot of pros and cons of both, and we'll talk about both. What's the company's potential for success in the future? You can tell me all day long how much business the company has done in the past. You can tell me all day long how much money the owner has taken out of the business. You can also tell me all day long how successful the business has been. But what's the future potential of that business? The marketplace changes today on a dime. Today, the marketplace changes overnight. Things happen. Hurricanes happen. Things happen from the standpoint of government and state and federal and local new rules and new regulations, new license agreements, and all that kind of nice stuff. Things change a lot. When I owned one of my medical centers, the city of Columbus, Ohio, took an easement right in front of my medical center to widen the street. When I owned my drugstores, some of my colleagues that were not my competitor, but were complimentary to me because they graduated pharmacy school about the same time I did, and they went out to a different geographic area and opened up their drugstore. All of a sudden, the city rerouted the traffic with a new avenue and a new lane to go through traffic, and that was away from their location. So consequently, we know that these things don't happen overnight. We also know that permits take a long time to get. We also know that we need to investigate all this stuff if we're going to buy a business, because we don't want to buy a business and then find out 2 years later that the city of Miami or city of Fort Myers or the city of Naples had plans in there to put something that would be detrimental to my business. So consequently, we need to do our homework. That's the bottom line of this whole concept of today's webinar. We need to not believe, but to do our homework. What changes will you have to make in the business? how extensive will those changes be? For example, let's not take a business, let's take a house. Let's say you buy a house, and let's say you get a bargain for that house. How much money is it going to cost you to get that house back into condition that you want it to be in? Well, you got to figure that into the cost of the business, into the loan that you're going to get. You have to figure out whether that business is sustainable the way it is, or will you have to make dramatic changes in it to change with the environment that's occurring in the next 10 years. How do we know what's happening in the next 10 years? We do our homework. There's plenty of databases out there that can tell you the outlook of what's going on in business. And all these databases are at libraries. For example, in the Lee County Library, where Fort Myers is, and in the Collier County Library, where Naples is, there is a database called IBIS World. IBISWORLD. That will tell you the industry as it's projected for the next 10 years. That will tell you what's happening in the industry, who the competitors are, what they're planning to do, and everything you want to know about. If you can't get it, consult your Small Business Development Center, because we all have licenses to that, and we can get it for you. There's another database, which I'll talk about next week. It's called BizMiner, BIZMINER. BizMiner gives us quantitative data. Quantitative data, we can get that down even to the zip code in where you want to buy your business. And we can give you percentages, numbers over the last 5 years and projections. Excuse me. This is something you have to do in your homework. Take your emotions out of it and do your work. Will the business generate sufficient cash flow to pay for itself and leave you a sustainable return on your investment? Again, the IBIS World and the BizMiner will tell you what the expected ROI is going to be of the particular business and industry that you're going to be going into. It even narrows it down not only by zip code, but it'll narrow it down by revenue size. Whether you're doing less than $1 million, more than $1 million, less than $2.5 million, it gives you all that data. The question is whether you take the time and effort to be able to do the necessary due diligence. I get clients a lot that come to me, and they're all excited about buying this business. At the end of the day, after we talk for about 2 or 3 hours, it comes up to, why do you even want to go into this industry? You've never been into it in your life before. It's losing money. Oh, well, he says, well, it's only losing money because the owner's taking a lot of money out of it and not reporting all the income to the IRS. Oh, well. Who says he's not reporting all the income to the IRS? You can't convince yourself that there's a good reason why a business is doing badly. You need to look at the numbers, you need to believe the numbers, and you can't be fooled by the seller who's trying to convince you that they're really making money, but it doesn't show up on paper. It doesn't show up on their tax return. It doesn't show up on their P&L statements. You need to be a smart buyer. So here's many of the advantages of buying a business. It may continue to be successful. It may already have the best location, and therefore you can't get a better location if it's a business that needs a physical location. Employees and suppliers are already well established. We'll get into that in a few minutes, because maybe those employees are no good, and maybe the suppliers are not the ones you want to use, but you've already got an established business going on. When I used to buy drugstores, absolutely I had employees. After 6 months, did I decide to keep those employees? Some I did, some I didn't. Same thing with vendors. At the time, after you get into the business, and you get into the nitty-gritty and get into the real weeds of the business, you'll decide which vendors are the right ones for you and which vendors are the wrong ones for you. But at least you have a starting place. And that's what I'm saying here. At least you have a starting place. Equipment is already installed. You have all the equipment you need. In a retail outlet, you have the POS system. You already have all the stuff that you need to run your business. If you're a restaurant, you have all the equipment. Is it the right equipment you want? Maybe not. But it gives you a starting point. That's an advantage. Inventory is in place. Trade credit is already in place. Is it the right inventory? Maybe not. Is it stale? Maybe it is. But at least it gives you a start to begin with, instead of buying and opening up, instead of opening up your own place and starting scratch. Credit terms, are they established? Well, maybe they were for the seller, but maybe they're not the same credit terms that the buyer wants, that the vendors want to give the new buyer, because you have no history with that particular creditor. So even though the seller tells you the type of terms that he has and how wonderful it is and all that kind of nice stuff, that may not apply to you. You know, when I had one drugstore, I didn't get very good terms with the vendors. I used to shop around for vendors all the time. When I had 6 drugstores, then the terms became a lot better. The dating became better. The discounts became better. They may not be good for you because, in fact, you don't have history. You don't have a credit report, a credit standing with those vendors yet. You're still the new kid on the block, even though you bought that business that's already there. Some other advantages, you can hit the ground running. You don't have to wait around for money coming in. You can use the previous owner's experience. And it's easier sometimes to buy an existing business to get financing. Everybody that we do business with, I just let somebody else in. Everybody that we do business with, we help them get SBA loans. Now, we'll talk about those SBA loans next week. But just to mention it to you here, in case you can't make it next week, every national bank and most local banks have an SBA specialist within their bank. That means that when you go get a loan, they're going to turn you over to the SBA specialist, and they're going to have that SBA specialist help you understand how to get into business, how to buy that equipment, how to buy that building you want. They are your friend. They're going to come to us. They're going to come to us, the SBDC, and ask us to help get your financials, your projected financials. See, they're not looking at history again. They want to see projected financials for 3 to 5 years, because you got to pay them back. And they want to see if you're going to have the cash flow to pay them back. We help you develop those projected financials. We help you develop that business plan for the SBA, for the bank, so that you can get that loan. And if you already have a business that you're buying that is established, it's much easier to establish those financial statements. And it may be a bargain. And then, of course, we have to know, why is it a bargain? Okay, so now, advantages. We already have current income coming in. We have built-in customer database, so the customers are already walking in the front door. They're already buying the product. We have employees that know the customers and have relationships with them, and that's very, very important. Because keep in mind, the first contact and last contact that the customer has is your employee. It's not you, it's your employee. And consequently, it's very important that they carry out the culture that you want that customer to understand who you are. It may already have a best location, known financials, and financials of income and expenses are already there from the past. So you can do projections. There's little downtime as you're up and running as soon as you take over. And financing, again, may be easier, and the price may be a bargain. So let's stop here and see if there's anything in the chat room. Okay, it says it was on the 1st or 2nd. It was on the first or second slide. Okay, I don't understand that, but I don't really see any questions here.
No, Neil, I'm sorry. There isn't no questions. Somebody had asked me
Right.
specifically about your
Okay.
website, which I sent to them separately, and then I went ahead and I posted for everyone else on the chat.
No problem. No problem. Okay, so we'll continue to move forward here. So let's look at some downsides. Okay, maybe the business is a loser and you don't even know about it. Maybe the financials are okay. Maybe you look at the tax return and you have some questions about it. You need to understand, is the business a loser, or is it really worth the money that the seller is trying to ask you for? Even though they already have customers, is there a lot of ill will, not goodwill, but ill will out there in the marketplace about the business? And how long will it take you to reverse that ill will into goodwill? Very important, because it's tough to, it's much easier to create goodwill in the marketplace than it is to reverse the goodwill. I'm sorry, the ill will into goodwill. Ill will only takes a second. It's all you have to do is have a disgruntled employee, disgruntled customer, disgruntled vendor, and they'll very easily, in today's world on the internet, badmouth you. And keep in mind, when they go into these channels like the Google channel or the Yelp channel and write reports on you, you cannot get rid of a negative report. You cannot get deleted. You can delete good reports, but you can never delete a negative report. So it's always there. So when you're on Google reports or Yelp reports, and people write something negative about you, the best you can do is write a response to those and explain what happened, and try to tell the world out there on the internet that you're sorry it happened, and you would like to make amends to that person that got hurt, had ill feelings about you, and try to patch it up, and then have them write a good report. You can never get rid of bad reports. I'm just telling you that for a fact. I've already indicated that maybe the employees are unsuitable. Maybe they're not the type of employee that you want to represent you, the new owner. The location, as I already indicated with my medical center and a friend of mine who owns a drugstore, the location may have become or may be becoming unsatisfactory. Again, your due diligence is extremely important. Maybe the area is no longer a Class A shopping center area, and it's now a converted to a Class C shopping center, and the tenants are moving out and they're moving someplace else. Well, you should know this. You should know how long the leases are in the shopping center that you're going into. You should know what kind of stores are thinking about moving out and moving elsewhere. You don't want to know that as a reactive. You want to know that as a proactive statement. Equipment may be obsolete. It may be bad. You may have to replace it immediately, and you may not even know it. So you need to have somebody come in and inspect all that equipment, all those things that you're going to buy as assets in that business. And there are people that come in and inspect it. For example, your insurance company is going to come in and inspect all of the equipment. Have them come in advance. Evaluate whether that equipment is actually valuable to use, what the life of that equipment is still left on it, and how soon do you think you're going to have to replace it. You may find out in the first year you've got a $150,000 expense you didn't plan on, and consequently that will affect your cash flow, and we don't want unexpected events to occur that you could have prevented if you did your due diligence. So again, this is a summary the location may be going downhill, the inventory may be obsolete, revenue model may be different than what you visualize. In other words, the revenue model is how they do business. Do they do business on a cash basis or a charge basis or a combination of both? Do they do business on a transactional basis or do they do business on a recurring revenue basis? Do they do business on a subscription basis or a non-subscription basis? All these things are extremely important to understand, and then understand the benefits and the downsides to each one of them, so that you can understand how you want to transition your new business into your revenue business model. Accounts receivable may be old and uncollected. So when you get into the next chapter of this, which is next week, we'll talk about revenue, receivable and inventory turnover, and stale inventory and stale receivables. And you keep in mind, if they're doing their taxes on an accrual basis and not a cash basis, they're reporting that revenue on their tax return that they haven't been paid for yet. And they could be obsolete, and they could never get paid for it. And you can find that out on their P&L statement if they're charging off bad debt expense, because bad debt expense is only charged off when you're keeping books on an accrual basis, and consequently is telling you how much money that they are not able to collect that they reported as income. And the reality is they really didn't get the income for that. And I call that pseudo income. So again, you need to connect with your advisors and the SBDC, because we have accountants that are on board at the SBDC that can help you sift through all this information. Think about the type of clients that they have. Are they all relatives? Are they all personal friends? What kind of relationship do they have? Because maybe those clients will no longer be your clients, because maybe they just had a relationship with the previous owner, and maybe they don't want to stay with you. Is too large of a proportion of the income comes from too few clients? I'm not sure I said that right, but let me say it again. Is a majority of the income that you get coming from a very small percentage of the total clients that you have? For example, are you getting 80% of your income from 20% of the clients? We got a problem. Maybe. And maybe that problem is that 20% of the clients, if 2 of them leave, where's the rest of your income coming from? Because they are the major source of your income. So we need to look at their client database, and we'll talk about that in 2 weeks. But I'm just bringing it up here so you understand you have a large, large job to do before you decide whether you want to buy a particular business or get into a particular industry. Keep the emotions out. Maybe the price is too high for the return on the investment. Think about you can in fact get a return on your investment. I'm going to bring somebody in again. Keep in mind that you can get a return on your investment in many other different ways, and maybe with equal risk. When we buy a business, and this is what I tell everybody that I value businesses for, there's a big risk in buying a business, and we call those in the valuation industry a risk premium. So the reality is the risk premium means that you need to expect to get a higher return on your investment because of the risk of going into a small business, a private business, and a business that you have no idea what's going to happen 5 years from now. What does that mean to you? That means to you that you need to pay less money for the business. Because if you're going to get a higher return on your investment, you need to pay less money. It's like if you go out and buy a stock. Let's say you go out and buy a stock from JP Morgan Chase Bank. If you pay more money for that stock, the reality is you're going to get a less return because you had to put out more cash for it. Okay. If in fact you pay less money for that stock and it grows, you're going to then have a greater return on your investment. It's the same thing with a business. So when we value a business, we say to you, there's a big risk premium. Therefore, your return on your investment should be larger than you can get in just putting it into the stock market, than just putting it into U.S. government securities. Because in the U.S. government securities, there's no risk factor. I can get today 5.2%. Well, if that's all I'm going to get in the business that I'm going to buy, then why am I buying that business? Am I buying it because I'm going to retire and I got nothing else to do? Bad reason. Okay. So we need to look at all those things in relationship to the price is too high, but you can't see it through the opportunity. That's what that means. The price is too high, but you can't see it because your emotions are taking over. And this is what happens to many clients we see at the SBDC. And we have to calm them down, we have to relax them, and we have to say, hey, look at the numbers. Look at the IBIS World report. Look at the BizMiner report. And now make a decision of what you want to do. Certainly it's your decision. But of course, we need to try to have you understand what the indication is for buying a particular business so that at least we can help you make a decision with some knowledge. An educated decision is what I'm looking for. Okay, so what type of leases are involved in the businesses you're buying? What kind of employee contracts are there? Many employees have contracts. Leases are very important. First of all, the tenant may not be willing to let the seller assign their lease to you. What does that mean? That means that if the seller is going to leave, you're going to have to negotiate a new lease for that property, and the landlord is certainly going to try to raise the rent on you and raise the cost of you being there. You need to be proactive on this. You need to be able to talk to those to the landlord. Understand whether the lease is assignable or not. Understand whether the leases on the equipment that they have are assignable or not, because they may not be assignable. You know, if you have an SBA loan and you sell a business, you're going to have to pay that loan back because you're no longer in business. If you have a partner that has signed on an SBA loan and they quit the partnership, they need permission from the SBA to get off of the liability of that particular loan. So it's not so easy to do all these things. And consequently, your due diligence will help you eliminate a lot of aggravation that you may have otherwise. So you need to yes.
Quickly, just a couple things that have popped up in the chat. So we'll start with the first one. Shanita asked what should she do to prepare herself to buy a business before she goes into a broker or into the SBDC? Like, what is it that she should take?
Number one, she should take 3 years worth of financial statements. That means a profit and loss statement, a balance sheet, and a cash flow statement from the seller. She should also take 3 years of tax returns. They may show quite different information. Some people can lie on their P&L statements, but most people aren't going to lie on their tax return.
Right.
So those are the first things that I would take, because that will give the consultant and the broker a good idea of what the business is doing, what it is, and also on the tax return, there's an NAICS number on the front page of the tax return.
That makes sense.
With that number, I can then go into IBIS World and BizMiner and get you all the information you need.
Excellent. Thank you for that, Neil. Another thing, Manuel had asked if you could post the links for the due diligence. Are we going to be sharing this slide with all the participants in the recording?
Yes, I will.
All right, so Manuel can get it there. And then the last question that Ryan asked is, where is the best place to find businesses for sale? I don't know if you're going to cover that now or next time or.
Well, I'll tell you, every chamber of commerce knows every business is going to be up for sale. So if you go to your local chamber of commerce or the chamber of commerce in the area in which you want to buy a business, that's where I would go number one. There are also sites on the internet, and every broker knows every business is up for sale. A broker doesn't cost you a dime. They want to help you find businesses up for sale, but don't sign a contract with them. Because once you sign a contract with them, it's like signing a contract with a real estate broker. You're locked into them for 3 to 6 months, and then you also have a waiting period before you can hire another broker. So business brokers are great to get information from, and chamber of commerces are great to get information from.
All right, thank you, Neil.
Any more?
No, that's what we had for now.
Okay. I thought I saw 2 more chats pop up.
Well, the one they asked about the due diligence for the links for hire and the zip code by revenue. I think it was like 3 slides.
Okay.
3 slides ago. Unless you want to maybe go 3 slides back, and Manuel could take a screenshot of it real quick.
Let me do that at the end, okay?
Okay, sounds like a plan.
Okay, so let's look at the uncovering the dark side. This is kind of a summary of everything I've already said. Is the industry changing? What are the barriers for you to enter that particular marketplace? There's always barriers. Number 1, there's competition barriers. Number 2, there's vendor barriers. Number 3, there's customer barriers. Number 4, there's financial barriers. All these barriers, once you might be in business, will kick in. The vendors may not sell to you. That's a barrier. They may have better relationships with your competition, and therefore your competition may tell them, hey, if you sell to this new buyer, we're not going to buy as much from you anymore. That happens all the time in the marketplace. Same thing with the customers. The customer barrier of other companies and the customers that were with this company may no longer want you to be their supplier of merchandise. Okay. Financial barriers, there's government rule, legal and licensing barriers. There are permit barriers. There are all kinds of government regulation barriers. These are things that you need to understand before you go into business. Go talk to the vendors. Go talk to the suppliers. Go talk to the competition. You know, whenever I was going to buy a drugstore, I went to the drugstores in my competition and talked to the owners. They're happy to talk to you because they like to brag. But even if they're not telling you the truth, in all cases, you're getting some information to put in your brain with all the other information to collate it to decide whether do you want to buy that business or not. Don't be afraid to ask questions. Today, we have the internet. It's very easy to get data in the internet on all the different social media pages that we go to. Look at the neighborhood. Is it changing? If you're going to be in a particular neighborhood, is the neighborhood going upscale or downscale? Do you see a lot of empty properties? Do you see a lot of houses up for sale? Do you see a lot of businesses up for sale? Do you see a lot of empty storerooms in that geographic area? That may be a sign that do I really want to go in that geographic area or in that industry? Is the marketplace changing? Are you going into a business that is supplying a product that is easily changing in the marketplace? We know the technology today is changing so fast that if we're developing something in technology, we better worry about what's going to come out next week, not next year, because that may be a better product for the consumer than the product that we are buying, or the patents we are buying, or the franchise that we are buying. So the reality is, before we make the kind of financial commitment necessary we need to understand all these things. And this is uncovering the dark side. What are the fixed costs that would be transferred to you? Fixed costs are things that you cannot really control. They're things like your rent, your utility bill, your telephone bill, your insurance. You know, I have a construction company who pays a liability insurance premium of $42,000 a year. $42,000 a year. Have you ever heard of that? It's not a lot of money if you're in the construction business. Why? Because there's a lot of possible risk and injury in that business. Get a hold of your professional, the insurance agent. Find out, because that's a fixed cost. It's a fixed cost. Every employee that you have requires workers' compensation. The type of work that they do will determine what your premium is on that particular employee. And it's based upon the wages of that. It's a percent of wages. Put your professional team together. I can't emphasize this enough. The issues that I have with many new buyers is they put together a team of uneducated people in that particular business. You can put together an attorney who's never done a buy-sell agreement. And I certainly don't want somebody that has never done a buy-sell agreement. You can put together an accountant that only does tax returns. I certainly don't want to put together an accountant that doesn't understand the business vernacular and the business industry and the analytical issues of financial statements and tax returns, because I'm not hiring that accountant at this point in time to do a tax return. I certainly don't necessarily want my family insurance person to be my consultant at this point in time. I want an insurance person that has an understanding of the industry and the business that I'm going into, that can give me the education and knowledge that I need. So I guess what I'm saying to you is, just to hire an attorney, an accountant, and an insurance person is not to say, hey, I did my due diligence, I hired my three people, and of course you have to have a banker. Say, I hired my 4 people, and consequently, I bought my business. Well, maybe you hired, for example, I'm not going to go and get a divorce and call a corporate attorney to represent me in a divorce. I'm not going to go and call a accountant to a tax accountant to represent me necessarily in front of the IRS due to situations that I may have. There are specialists in every particular area. You need to make sure that you're hiring people that have the expertise to give you the knowledge and the education that you need. That's all I'm trying to say. Not just because I got a friend who's a banker, I got a friend who's an accountant, I got a friend who's an insurance person. That doesn't work for me. You have to hire people that understand business, because you're buying a business. You know, many attorneys do buy-sell agreements, and many of my clients send it to me, not to look at it from a legal standpoint, because I'm not an attorney. I'm an accountant, I'm a CPA, and I'm a business advisor. They send it to me so that I can evaluate the contract from a business position, and then maybe give the attorney some input about what I think additional items should be in there for a business purposes. But I don't draw up the contracts, but I work with accountants and I work with other CPAs to help them get a more business-like document to represent the client, to help protect them and to help reduce the risk of loss. So acquiring a business requires analysis for your skill, analyzing your skills, analyzing your abilities, and analyzing your interests. It also requires preparing a list of potential candidates, investigate and evaluate candidate businesses. It also involves to explore financing options, and we'll go into that next week. What are my financial options, financing options? And we need to make sure that we ensure a smooth transition between you and the seller and the vendors and all vested, I call it vested companies and vested people. There are 5 critical areas of analysis in an existing business. Why does the owner want to sell? Why I want to know the real reason. Okay, very critical to me. Second of all, what is the physical condition of the business? Analyze the physical condition. That means physical condition, meaning the financial condition also. What's the potential for the company's products and services in the future? Remember, you're only buying for the future. You're not buying for what they did in the past. They may have done hundreds of thousands of dollars in the past. What's that potential for the future? Customer characteristics and composition change. Competition changes. So we need to look at the analysis of the competition. What legal aspects must I consider? Every single business has legal aspects. So what are the issues from a legal standpoint do I need to consider? Is the business financially sound currently? And these are some of the legal aspects of buying a business. Are there liens on the property? Are there liens that the creditors have on the assets? Well, if there are liens, then you should be able to find out because they have to be filed with the Secretary of the State. But there may be some liens that weren't filed with the Secretary of the State. Okay, bulk transfer. A bulk transfer protects business buyer from the claims unpaid creditors might have access to a company's assets. Again, our lawyer needs to check all this out for us. Contract assignments. Again, I mentioned this. Are the contracts that you may have and the leases assignable? Do they have the right does the seller have the right to assign them to you? You need to look at those contracts, send them to your lawyer, and have your lawyer confirm that they are definitely assignable or not assignable. We don't want to take anybody's opinion. We don't want to take the seller's opinion that they are. The legal aspects of buying a business. What are the restrictive covenants that you might have in a contract in which a business seller agrees not to compete with the buyer within a specific time and geographic area? That's a real problem right now because according to the federal government, restrictive covenants are possibly illegal because the federal government came out recently and stated that it is illegal to restrict the livelihood of another individual. And so this is going to go through all the courts, I'm sure, but you need to understand if there are any restrictive covenants and if in fact, are they going to be enforceable or not enforceable? And again, your attorney needs to be in this conversation. Ongoing legal liabilities. Are there any legal liabilities, for example, in the shopping center in which you may be going into? If there are, you may be out of a space if those legal liabilities turn out to be negative for the landlord. Are there any liabilities for the product and any labor issues that are going on in the company and any lawsuits? You don't want to inherit all this baggage. So you need to make sure that or as much as you can, you need to understand whether there's any baggage that you're going to be picking up or not picking up. Determine the value of the business. Again, we look at the balance sheet technique. We look at what we do when we value a business. We take the balance sheet and the income statement of the particular seller, and we make adjustments to it. Why do we adjust it? Because just because that seller had those expenses doesn't mean that you, the buyer, are going to have the same expenses. So we take those expenses and we make adjustments to what we think it's going to cost us to run that business. and how much revenue we think we're going to make. And then we come up with what we call an adjusted net profit, and to see if the net profit that the seller is making is going to be consistent with what we calculate based upon their P&L, whether ours is going to be the same, greater, or less. So that's what we do. And that's what we do at the SBDC. We help you do those things. We look at the earnings approach. The balance sheet approach looks at the assets. It says, okay, are there any assets and liabilities that we need to be concerned about? Are there any assets that are old? An earnings approach goes into the P&L statement. And then we go look at the P&L and we evaluate all the things I just said about our P&L. Okay? Capitalizing the earnings means how much return on investment do we expect to make? And therefore, what's that business worth based upon that return on investment? So the larger return on investment, and we'll go through this next week, the larger return on investment that we expect to make, the less we're going to pay for that business. The smaller return on that investment that we are willing to accept, the more we're going to pay for that business. And that's just all simple math, okay? And then we look at the future earnings. And then we look at the market approach. So these are three approaches as valuators that we look at. What's the market approach? The market approach says to us, what's the market doing? Is the market changing that we're not going to be very relevant in the marketplace anymore? Is the marketplace changing that we are going to be more relevant in the marketplace? So we do a marketplace approach, and IBIS World helps us do that. And we can even get into the geographic area in which we're going to be doing business. And by the way, I might also add that if you're thinking of buying a global business, we have an international consultant on every SBDC's payroll. So this is yeah.
Things really quickly. Louis asked, is there buying an online business, like an online store, etc., different? Is buying an online business different than what you're talking about, like an actual, I guess, live, in-person business? Is it
brick and mortar.
Yeah. It's a little different, but the due diligence is not different.
Okay.
Certainly, you don't have to worry about a physical presence. You certainly don't have to worry about a lease on a brick and mortar place, but you also have to worry about all the other issues.
Got it. Understood. And then one other thing Eric asked, do business evaluations usually include or exclude inventory? He was offered to buy a company at 3 times the desk income, but it did not include the inventory. Is that customary? It sounded weird.
Well, if it doesn't include the inventory, I want to know why. Is it because all the inventory is obsolete? That's customary.
Right.
It's not that you're not buying the inventory. It just means the inventory has zero value in your valuation, you say. But if you're not buying the inventory, how are you going to start out your business? You're going to buy all new inventory? Then if that's the case, you better put in the pricing for that. So when you buy a business on a percentage of the EBITDA, that's what you're talking about, EBITDA, which is earnings before interest, taxes, depreciation, and amortization. That's called a multiple. So when you say 3 times, you're talking a multiple. So you're willing to pay 3 times the value of the net earnings, which means you want to make a 33% return on your money. That's what that means. That's what 3 times means. If you're going to pay 5 times a multiple, that means you're going to make 20% return on your investment. Now, these research documents like IBIS World and BizMiner will give you the average multiple that business in that industry has sold for in the past. And that will give you a guideline of what the multiple is. And a multiple is simply a number from the EBITDA, that's earnings before interest, taxes, depreciation, and amortization, which tells you that I am willing to make X number of dollar return on my investment. Because if I pay 5 times EBITDA, that means I'm willing to only make a 20% profit. If I'm paying 4 times EBITDA, I'm going to make 25% return on my money. If I pay 10 times EBITDA, I'm only going to make 10% return on my money. So the amount of EBITDA that you're going to pay for a business is telling you indirectly that that's the return that you're going to make if you convert it to dollar bills. That make sense?
It does. Thank you, Neil.
And we'll cover that in detail next week. But I only
Okay.
mentioned, yeah, I only mentioned
We
that.
jumped a little bit ahead.
Yeah. Any other questions?
No, that was it. Just those two.
Okay, so this is the last slide. So this is kind of a summary. We got to prepare. We got to poise ourselves for negotiations. We got to keep that emotions out of it. It's all business. We have to be persuasive, and we have to be persistent, and most important, we have to be patient. All right, let's not jump the gun. Let's do all of our due diligence. Even business brokers are going to want you to jump the gun because they don't make any money unless you buy that business, because they're getting a percentage as a commission of selling that business. Okay, so think of a business broker same as a real estate broker. So this is we want to make sure that you put yourself in the picture. And next week we'll start talking about non-disclosure agreements. All right, so this is kind of a advertisement. Part 2 of buying a business goes into the financial and investigative methods of buying a business. It's next week, June 11th, 2024. Tuesday, webinar, same time, 11:30. You can get the registration on this website. Write it down. Click on training. And then click on the website that says Buying a Business Part 2. It's got my picture on it, and you can register for it there. Okay. Just as a heads up, SBA and me are doing another webinar on June 27th, 11 o'clock, and it's all about financial statements and capturing why there is value, meaning, and how financial statements impact your business. Again, at the same website, you can click on that. It's got my picture on it, and you can register. Okay? What I would like you to do is take a picture of this. Not take a picture, put your telephone up on here, because our SBDC wants to get a survey. It's a three question survey of this webinar. So if you put your camera, your telephone up to this, it will take you to the website for the survey. And I'll leave it there for a second. And I see there's some more questions there. Do we want to answer those?
Yeah, well, they said we can please get a copy of the slides. I put a thumbs up. We'll definitely send it out. And then if I can add the links, which I'm actually was just looking for the flyer that I had sent out, where it'll have the links to register for the Part 2 next week.
Right.
And then for the financial statements, I actually have July 8th as the date. And so I'll go ahead and right now I added those two where you can go ahead and register. Oh, I think it's because I hold on, it has too many.
Did I put the wrong date for financial statements?
You did. It's okay.
Okay. All right. I'm sorry. I'm doing that for Suncoast that date. Okay. Sorry about that. Let me go to slide 3, because somebody said they wanted me to go to slide 3.
Yes.
It'd be better if I get out of this and just go to slide 3.
Okay.
Is that the slide?
No, you know what? No, go forward. The slide that he was referring to was a due diligence one.
Okay.
Well, I don't know why I'm getting this error message.
I'm looking at all the slides here.
This is for the Part 2. There we
Is
go.
it this one?
Oh, no, no, go back, go back. It was before the disadvantages, 3 before that. So check out 14. I'm not sure now which one it was.
Well, they're gonna get the slides anyway.
I was just gonna say that they're gonna get it. So, so anyways, I went ahead and I put the part 2, like I said, next Tuesday at 11:30, and then the financial statements capturing their value, meaning and impact of the business on July 8th. So do please make sure to register that. I will send it out, the part 2 and this one also in the newsletter, like I've been